So let me start, Michael, first by just giving my background and how I got involved with emerging markets, how I think about investing. And then I'll summarize for you what I think are the most important things to know about investing in China and emerging markets. And then I'll hope to convince you that our version of emerging and frontier markets is the best approach for long-term investors, as it has been over the last 7 years since we launched. So now I have two different products I'm involved with. Our flagship is EMQQ, which tracks all emerging markets internet companies, of which there's 118 publicly traded now. Alibaba, Tencent, the largest of those. And then, and that fund will be 7 years old in a couple weeks. And then a month ago, we launched FMQQ, which really is simply EMQQ without China, but because China is such a big part of EMQQ, we call it the next frontier, and we'll show you why that is and why that part of the story, the internet reaching India and Nigeria and these places, why that's such a big deal. But in terms of my background, how I got here. So I started in the investment business here in San Francisco 28 years ago. I had one interview when I got out of college with a company called Robertson Stevens and Company. And the interview lasted 20 minutes. The first 19 minutes, we talked about college basketball. And then I was given a 1-minute overview of the investment business. And then I was told that I could start Monday. And I responded immediately, how can I possibly start on Monday? I don't know anything about investing. And the guy that was interviewing me said, well, go and buy this book. And he wrote down A Random Walk Down Wall Street. Now, some of you probably know this book. It was published initially about 50 years ago, before there were index funds. And the author, Burton Malkiel, a Princeton economist, suggested in the first edition that somebody should make an index fund. And a couple of years later, his friend John Bogle did, in fact, launch Vanguard with the first index fund. And so this book and its author have long been associated with indexing. And Bert is a longtime Vanguard board member and also was the chairman of the committee that created the first ETF, the Spider. So that's how I started my career, but I very quickly gravitated towards Omaha. And I try to think about everything in the business and investing world through a Charlie Munger and Warren Buffett lens. But for the last 22 years, I've been business partners with this guy, Princeton economist Burton Malkiel. So I've had one foot in the active world, one foot in the indexing world since 1999. And the first thing that Burton and I did together was create what was the first fractional share brokerage firm, a company called E-Investing that allowed investors to trade in dollar amounts instead of share amounts. That company was acquired by E-Trade in the year 2000. And then we launched another company called Active Index Advisors, which was a pioneer in what's now called direct indexing, building individual customized S&P 500 portfolios, for example, where you could leave out tobacco stocks or things like that. And you could also do tax loss harvesting in an effort to beat the index. And that business has worked out really well, but we sold it to Natixis at the very end of 2004 in December. And a couple months before that, however, Google went public. And when they did, they had an investor planning day for their employees, and they had two guest speakers. One was Bill Sharp, and the other was my partner, Burton. And I wasn't involved, but I had dinner with Bert the night before, and it sounded cool. And a couple months later, my phone rang, and it was a guy from Google who had apparently Googled me and said, hey, I heard about this active indexing. How do I invest in your active S&P 500 strategy? And I said, well, who's your advisor? And he said, well, I don't have an advisor. And I said, well, we don't work with individual investors. We're available through advisors at Morgan Stanley and Credit Suisse and Deutsche Bank. And I can make an introduction. And he said, no, I don't want to do that. I'd like to just invest directly with you. And one thing led to another, and I agreed to let him do that. And then I became the default investment advisor to about a dozen of the earliest Google engineers in the beginning of 2005. Now, at the same time that I am now going back and forth to Mountain View from San Francisco, Burton begins going back and forth from Princeton to China. A couple of his colleagues from Princeton had gone back to teach economics in Beijing, and they convinced him he had to come and see what was happening on the ground there, and that the economy really was coming back strong. And all of Burton's back and forth led to a white paper published in the Journal of Investment Consulting that later became a book. And the Google people found out about this and called me and said, hey, can Burton come down and give a talk about investing in China? And I said, yes, next time he's in San Francisco, we can schedule that. And it was 15 years ago that I drove one morning with Burton from San Francisco to Mountain View, and Burton gave his talk about investing in China. And then all these people looked at me and said, we want to invest in China. And at that point, I had never been to China in my life, and I didn't really know anything about China. But for the last 15 and a half years, my entire life has been devoted to figure out what on earth does that even mean to invest in China, and how should an investor go about doing it. So with that lengthy lead in, let me tell you what you ought to know about China and emerging markets more broadly. So first and foremost, when we sort of frame up what we're talking about, if you looked at it on the map, emerging markets, frontier markets, we consider all of this, both emerging and frontier, to be part of our universe. This is about 60% Asia by population, by market cap, by GDP. About 60% of this is an Asia story. About 20% is Central and South America, and then approximately 10% Africa and Eastern Europe. So that's what it looks like on the map. Fundamentally, it's the world. It's 85% of the world's people are in emerging and frontier markets, and it's even more of the future. Young people, there's about 90% of the planet's people under the age of 30 are in emerging and frontier markets. Their GDPs have been growing faster than ours. Their economies are bigger now collectively than the developed world economies. But if you look at the right side of this slide, excuse me, it's hot. The right side of the slide, you'll see three red arrows pointing out at the top, again, that emerging markets is where all of the people are in the world. The two lower red arrows are pointing out that in the consumption categories, retail sales and consumer spending, emerging markets are way, way behind. And that is lesson number one. The thing that's emerging are the people. That gap is closing as these people move on up, and they want stuff. They want all of the stuff that we have taken for granted for generations, perhaps. They want more and better food. They want more and better clothing. They want appliances. They want entertainment, vacations, cars, and they want their kids to go to college. And that's the story. I didn't have to figure this out, by the way. It was pretty well documented when I got involved. And as you can see at the bottom of the slide, McKinsey and Company has concluded that this is not just a big deal, but in their words, the biggest growth opportunity in the history of capitalism. So that is what everybody should be focused on if they're investing in emerging markets. And it is the foundation of EMQQ and FMQQ. So we'll come back to that. Now, the other thing that people need to know about emerging markets is that there's a pretty significant flaw in the whole system. And it, I think, has distorted a lot of things. And it has to do with what is actually in the indexes in the developing world. And this is something that I learned about on my first day. In fact, the first 5 minutes. So after Burton finished his talk in Mountain View, we had lunch there and at Google, and then drove back to San Francisco and went up to the offices, and I went straight over to our portfolio managers and I said, look, the Google guys want to invest in China. Give me a list of all the companies in the iShares China ETF with the ticker FXI, which was the first and only China ETF available at that time. And I assumed that is what we would use to get this China exposure that these Google people wanted. And with my Omaha hat, I always like to look and see what's actually in the ETF, not just the title. And before they gave me the list, Burton pulled me aside and he said, look, when you get the list of all the companies in the China ETF, you're going to see that almost all of it is Chinese government-owned banks and oil companies, state-owned enterprises. And I said, yeah, Bert, I've heard about that. And that doesn't sound good to me. And he said, well, let me give you an example. And the example was this. He said, you've got a Chinese manufacturing plant. It's been losing money for a decade. It's incredibly inefficient, and it's about to run out of money. But it's got 15,000 employees. It goes to the state-owned bank and says, we need more money. Now, a normal banker would say, no, you can't have any more money because you're bankrupt. But the state-owned banker doesn't say that. The state-owned banker says, well, we can't have these 15,000 employees out in the streets protesting. And so it makes another loan. And when Bert gave me that example, I got nauseous inside because in my simple Omaha brain, earnings equals value and the growth of earnings equals the growth of value. And you're telling me the people in charge of these companies don't care about that. Why would I invest in them at all? And in the case of the China ETF, it was 80% state-owned enterprises and less than 10% in the consumer stocks. So this is a real problem. It's not as big a problem anymore. It's not as big a problem in the broad emerging market indexes, but it's still a meaningful problem. In fact, I think it's a big enough problem that you really can't use the traditional Vanguard and iShares products if you want to make any money, because these things are a real cancer. The best example of this is in Brazil, where the last two presidents of the country both went to jail for basically stealing your money as they looted billions of dollars from Petrobras. And so about a third of the index are in these types of companies. And if we counted two other groups, the chaebol and the oligarchs, it's half the index. And these companies have a lot of the same problems, including people going to jail, like this guy, the chairman of Samsung, who has now been incarcerated 3 times in the last decade, most notably for bribing the president of Korea, who also went to jail. And then most recently, last month for a prescription drug law violation. So this is why you can't do what people like Bridgewater do. You can't just buy the broad index because it says emerging markets and think you're going to make any money. You got to avoid these traditional approaches. It makes me crazy that the biggest hedge fund in the world has 5 positions in their top 25 that are if I was making a list of the worst ways to invest in China and emerging markets, these would be near the top. So you gotta evolve and do what we call emerging markets 3.0. So in my first 8 years working on China, Burton and I launched a number of China ETFs with Guggenheim that were subsequently acquired by Invesco. But when I wasn't working with the Guggenheim people, I was in Boston and New York with a bunch of family offices and foundations and endowments. And I saw how they were evolving their approach and increasing their allocations. But as they got bigger, they were, and saw they weren't really making any money and saw people going to jail. they decide they need to get a little more targeted. And the best example of this was Yale, where David Swensen took a young rising star in the endowment office who was a graduate of the university and Chinese, and they sent him back with a bunch of the university money to invest, and that worked out very, very well for Yale and a lot of other investors, and for Hill House, the group that they formed. But most people didn't have $50 million, and they weren't David Swensen. And so I eventually, when people asked me, what's the best way to invest in emerging markets, I told them, just buy the consumer sector. Leave out the oil, leave out the banks and the corruption and the legacy economy, and just go where the growth is. Go where McKinsey says the growth is not just big, but very big. And so for, starting about 7 years ago, or I guess 10 years ago, probably, when people would ask me what's the best emerging markets ETF, I didn't tell them to buy one of my funds with Guggenheim. I told them to buy the emerging market consumer ETF, which has the ticker ECON, Econ, which owns the 30 largest emerging market consumer stocks. I have nothing to do with that fund. I never have had anything to do with that fund or the group that launched it, but I knew it existed. And if you believe McKinsey, that was the ETF whose title matched this slide. And about 8 years ago, I woke up one morning and I looked in the mirror and I thought, oh my God, what have I done? I was this young, cocky value investor stock picker, and I somehow got mixed up with this guy, Burton Malkiel, and today I'm building Chinese index funds. And that's not what the career path I was seeking. So I need to get out of here immediately. And I told the Guggenheim people I was going to set up my own investment partnership, and I did. And once I had it set up with my own money, I invested it in 5 stocks. And then after a few weeks, I thought, well, I should at least see if anybody I know in town wants to invest with me. So I scheduled some meetings, and the morning of those meetings, I made some slides to show the people I was going to be meeting with. And one of the slides was a list of the 5 stocks that I had invested the partnership in. The first 3 stocks were all in the emerging market consumer ETF. Those 3 stocks traded in Hong Kong. Want, which is like the Nabisco of China, branded crackers, snacks. Second and third companies, Li Ning and Peak Sports. You can think of these as the Reebok and Converse of China, sportswear and basketball shoes. So those were the first 3 stocks, all called consumer stocks, all in the emerging market consumer ETF. But then I had 2 other companies that were clearly part of this emerging market consumer story, but they were not part of the emerging market consumer ETF because the database didn't call them consumer companies. The database called them technology companies. The first one traded on the New York Stock Exchange was Wuba, W-U-B-A. That's the Craigslist of China, which has gone private recently. And then the 5th and final company trades on the NASDAQ, and it's called Mercado Libre, M-E-L-I, which is the Amazon.com and the PayPal of Brazil and every other country in South America. And so those were the 5 stocks. And I looked at the slide after I made it, and I thought, all right, well, these 3 consumer companies, the food and clothing companies, they're great. I think they have a moat, each of them in form of brand equity. They're growing at 15 or 20%. But then I looked at the 2 internet companies that were clearly part of the consumer story. No matter where you put them in the database, they were growing at 100%, 7 times as fast. And they had incredible profitability. Wuba had a 94% gross margin. And when I look for moats, that's where I look first. And while their PEs for those 2 internet companies were higher than the PEs for the consumer companies, when you divided those PEs by the growth rate to get the PEG ratio, the PEGs were actually lower and quite reasonable. And I remember thinking, My two best emerging market consumer stocks aren't even called consumer stocks. And that was it. I printed my slides. I went around town and got a few checks. And on my way home, I was at a stoplight and my phone rang. And it was a friend of mine with a 3-year-old daughter. And she said to me, "What's the best emerging markets ETF for my daughter's college fund?" I started to tell her to buy the emerging market consumer ETF, but then a light bulb appeared above my head. And I said, wait a minute, the best one doesn't exist. And I went back to my office and immediately started to organize EMQQ. And it launched 100 days later, it launched 7 years ago on November 12th, 2014. So let me tell you how to think about EMQQ. It wasn't as clear to me then as it is now, but it's pretty clear to me now, and it's a pretty big deal. And we call it the Great Confluence, which is just a fancy way of calling it a mashup. EMQQ, the Great Confluence, represents 3 different mega trends, 3 big, powerful, secular trends that are happening in the world, all of which we're part of. But we are perhaps not as cognizant of these things because we were the first people involved in each of these 3 big trends. So let's talk about what those 3 things are. We've already talked about the first one. Everybody else wants stuff. Our economy has been consumption dominated for a long time, for generations. Well, most of the world is just now getting that second pair of shoes, that extra pair of pants, that toaster, etc. So everybody else is becoming a consumer. Now, when I got that call 7.5 years ago, I answered it on my iPhone, which was sitting on the car seat next to me. So I had a smartphone at that point, but it was pretty new to me. And I could already see how it was changing my family's consumption, and the trips to the Target store were going down, and the trucks were showing up seemingly at an increasing rate to leave a package at my house. But I had a computer for 20 years before I got a smartphone. So the second mega trend is the computer, something I got in 1988 in my dorm room in college. Well, the reality is most of the world's never had a computer. So all of these billions of people are getting their first ever computer. It's not on their desk, and it's never going to be on their desk. What's happening is the $60, $70, $80 Android-based smartphone is bringing the computer to the world for the first time, and it's bringing the third mega trend with it, which is called the internet. I got the internet in 1995 on a telephone line in the Marina District of San Francisco. It then went on to the cable, and now it shows up in my pocket. Well, most of the world never got wired. So not only are these people getting their first ever computer, they're getting their first ever access to the internet. And because the consumption infrastructure in emerging markets is by definition underdeveloped, and by consumption infrastructure, I mean the following types of things. Most importantly, people don't have a bank account with a debit card. They don't have a TV on the wall with 1,000 channels. And there's no Target store to drive to, even if they had a car. And so these people are leapfrogging what we think of as traditional consumption, and the result is off the charts growth. This is the money slide, literally and figuratively. This is showing you the revenue of the 118 emerging market internet companies that are in EMQQ. And You can see that they've grown at an average annual rate of almost 40% a year for 12 years. Now, I'm not 100% sure of anything in the world, but I have given this presentation to hundreds of professional investor groups, and I offer a $100,000 cash reward to anybody that can show me a sector of publicly traded companies that ever grew at this rate for this long. I've asked everybody I know who's smarter than me and older and wiser than me if they can think of a sector that may have grown at 38% a year for a decade. And so far, my inbox is empty. So I could be wrong. I'm not 100% sure, but I'm pretty sure this is not only the fastest growing sector of the world today, but indeed the fastest growing sector in the world ever. So that is the result: growth. And what comes with that? Value creation. So in gold here, you can see how the EMQQ index is done. And in blue along the bottom, you can see how the MSCI, the broad index, is done over that period. And you can see that people made a lot of money in the internet sector, as they have here. And meanwhile, the broad traditional index has gone almost nowhere. I mean, it's up 57% in 12 years, but all of that came in the last 18 months. And if we made this a 14-year chart, you just got back to break even. So a lost decade in the traditional approach of measuring emerging markets and investing in ETFs. And I think ultimately that the MSCI is the biggest value trap in the world. It looks cheap. People say, look at the PE, it's 11 or 12, and it's half the PE of the S&P 500. Well, if you knew what the Agricultural Bank of China was, you probably wouldn't care what the PE is, and you'd just avoid. So that's it. Fundamental growth, value creation. Now, this has been led by the Chinese giants, Alibaba, the biggest and best known of these companies. And let me point out one other problem with the indexes. And that is that most of these companies historically have gone public in the United States. And the reason is they're getting funded by Harvard or Stanford or Yahoo or Berkshire Hathaway. And so they choose to list on the best exchanges in the world, which are the NYSE and the NASDAQ. And because of that, most of these companies have not been included in the broad index. And that bothered me from the very first day when I told you how I got back to San Francisco from Mountain View, and I asked for a list of all the companies in the China ETF. And I got to the bottom of the list, and Baidu was not on the list. The Chinese search giant had gone public before Google, and it wasn't included in the China ETF. And we called the iShares people and said, hey, where's Baidu? And they said, we don't own Baidu. And I said, I can see that. Why don't you own Baidu? And they said, we don't own it because we don't consider it Chinese. And I said, what do you mean? It's the Google of China, and it seems like a good thing to be. And they said, well, it doesn't trade there, so we don't include it. And I said, that's the stupidest thing I've ever heard. And now it took about 10 years for that problem to get fixed. And it wasn't until Alibaba's high profile IPO that anybody talked about this. And I couldn't believe that Consumer Reports and the USA Today wrote articles about what was wrong with these indexes and how they weren't, you weren't going to find Alibaba in your Vanguard fund. And but it still took 3 years after Alibaba's IPO before Alibaba and some of the others were added to the broad indexes. About half of our stocks are still not, for a number of reasons, included in the broad indexes. So now Tencent's the other China super app. And so the story's been dominated really by these two companies as they've grown quite large. And importantly, you can't think of these as tech companies. These are consumer companies, and they're digitizing every part of consumption: healthcare, entertainment, food, and groceries. This is Alibaba's grocery store, Hema. The things happening in China around food and the distribution of produce and things like that is really amazing. And we could do an hour or two just on that sub story. But the biggest part of this digitization is the money, where everything is getting digitized, and we are getting left way behind in this story. And in China, that's an Alibaba Tencent story. So the money's on the phone. The gateway is the payments platform. But once you get the money on the phone, then you can get into all sorts of financial services. You can get into the investment product business. You can sell insurance. You can provide banking. And the banking part is the juiciest part. And Alibaba's Ant Group was making a fortune in that part, but in a way that needed to be better regulated. So we'll maybe talk about that. But either way, I can't stress enough how big the fintech story is in emerging markets. And it's quite a paradox. You would think somebody like me, a fintech entrepreneur in San Francisco, I would be the person most advanced in using my smartphone for financial services. It's not me. It's Africa, whose mobile payments business is most developed. And again, it's this leapfrogging where people are skipping the bank account and going straight to mobile money. So we'll talk more about that trend. So now there's other major China companies and even smaller ones, but Pinduoduo, JD.com, Meituan, Baidu, these are all some of the other companies beyond Alibaba and Tencent. But now let me tell you what's going on beyond China. There's a lot of negative talk around China these days. I'll address that. But what's happening in the internet and e-commerce world in India, in Uruguay, in Kazakhstan is really exciting, and investors ought to be very interested in what this story is. So first, let's put one thing in perspective. China dominates. China's e-commerce market, the biggest in the world by far. And the EMQQ, which includes every emerging and frontier market, is eligible. There's 46 countries, emerging and frontier. The other 45 beyond China, if you added up the e-commerce of the other 45 emerging and frontier markets, e-commerce, China's is 4 times bigger. So China really is its own big thing. And you can see that's why China dominates our index. And actually it dominates it even more on a fundamental basis. It's about 80%. Fundamentally, it's about 65% of our portfolio. The reason it's not bigger, one of the reasons it's not bigger, is because Alibaba and Tencent are very large, and we have an 8% limit on the most we'll put into any single stock. And so that sort of artificially pushes Alibaba and Tencent down. But China dominates. But what's happening in the other 45 countries, the next frontier, is getting very exciting. So you can see here that same revenue I showed you earlier, but this time you see it broken into 2 pieces. The blue is the China revenue. The gold at the bottom of the bar is the non-China revenue. And you can see that the beyond China, the FMQQ as we call it, revenue is passing $100 billion. Which is where the China companies were 7 years ago when we launched. And you can see that China revenues quadrupled in those 6 years. And now we've seen the growth in this part of our portfolio. I mean, China dominates the fund, but this company's been one of our best performers over the last several years. Now, again, I'll stress, databases are a problem, I think, in investing, and particularly when you get into emerging and frontier markets, because everything's got to get put in a box and then data is reported. This company will show up as Argentina on our fact sheet. They are headquartered in Buenos Aires, but their biggest market is Brazil, which is about half their revenue, followed by Mexico. But really, this company has revenue from every country in Central and South America, even those that aren't even on the investment map, like Costa Rica, Nicaragua, the Dominican Republic. So this company dominates e-commerce, dominates fintech all over Latin America, and it's performed very well because of the strength of its fintech business. This company you won't find in the Vanguard fund or the iShares fund or the big indexes. Other notable company that we've seen really perform well is this company, C Limited. Now, some of you know this company, but probably most of you don't. This is, I think, the best performing stock in the world over the last 4 years. It was at one point. It's been neck and neck with Tesla. I think Tesla's had a nice run, but C Limited, which trades on the New York Stock Exchange with the ticker SE, is headquartered in Singapore. Fact sheet will say Singapore. This company is generating revenue in gaming, in e-commerce, and in payments, 3 different platforms. And it's doing it in all of Southeast Asia. It's in the Philippines, it's in Indonesia, it's in Laos, it's in Vietnam. And so again, the fact sheet will say Singapore, which is a nation of 5 million rich people, but this company is really generating revenue from the hundreds of millions of people all over Southeast Asia. And its shopping app is also one of the leading shopping apps in Brazil, of all places as well. So C Limited's been a great performer, not included in the indexes. This is a company we've owned since inception. This is the Google of Russia, which has also become the Uber of Russia. Uber did compete, but got beaten by Yandex. Now Uber owns a minority stake in Yandex Taxi, which will probably IPO in 2022. The Nigerian e-commerce leader, Jumia, trades on the New York Stock Exchange. It operates in about 10 African countries, and it's also got a very young fintech business. It's also the most volatile stock I've ever owned, but it's like a call option on the future of Africa's e-commerce market. And in the last 9 months, we've seen this story start to spread into all corners. We had the largest company trading in Warsaw now is the Amazon.com of Poland, Allegro. Uruguay has a company called dLocal, which trades on the NASDAQ. This is one of my 2 favorite companies in South America. This company's growing at 100%. It's got great margins. And it actually operates in about 50 countries. You see the digital map on the left. They have a fintech background to enable e-commerce that is generating revenue from everywhere in the developing world. The Turkish e-commerce leader, founded by a woman, went public this summer on the NASDAQ. A couple months later, the e-commerce leader of Indonesia went public in Indonesia. There's a publicly traded super app from Kazakhstan trading on the London Stock Exchange. Cusp stock has done very well. So even Kazakhstan has its internet giants that are publicly traded. Now, India is about to go off. This company, Zomato, went public a month ago in India, and it marked an important point. There's now more non-China internet companies in the EMQQ universe than China. I don't think there will ever be more China companies again. And the number of non-China companies has tripled from 20 to 60 in the last 2.5 years. So there's been a lot of IPO activity, and there's a lot more coming with India leading the charge. There could be 25 India internet IPOs in the coming couple years, and that's about to start. And it's not clear, this next one, this is going to be on the front page of the Wall Street Journal this month, I suspect. This is the Indian fintech leader Paytm, which counts Alibaba's Ant Group as its biggest shareholder, but it also counts my heroes in Omaha, Berkshire Hathaway, an investor in the company in a private round 3 years ago. And this company is going to come public in the next couple of weeks. Now, it's going to list in India. So I don't know that it'll get as much coverage as it might had it listed on the New York Stock Exchange, but it will be in the papers. You'll hear about it. And it's good to be the fintech leader of India because nobody has a bank account, or not. Lots of people don't have a bank account, lots and lots. And the government's really pushing digitization of everything, and importantly, specifically the financial services. So this company has a very bright future and will come public soon, Paytm. Following that, in Q1, we should see FLIPKART. Now, this is the e-commerce leader in India. Amazon competes, but FLIPKART's presently got the largest market share. Walmart controls the company. Tencent is an early investor. Now, this company will probably come public here on the NYSE in the first quarter. So this one will probably get more coverage than Paytm. Southeast Asia has this fascinating company that is a merger of two companies. Gojek is merging or has merged with Tokopedia. Now, let me use this example to point out a couple other nuances that are evolving in the story. So Gojek is the Uber of Indonesia and a lot of other Southeast Asian countries, but Indonesia is the one that has the most people by far. So Gojek is the Uber, and their logo is a motorcycle. So all of this is on mopeds and scooters and motorcycles. So you're getting on the back when you push the button to get a ride. Now they're going to give you a helmet with their logo on it, and you can wear that, but you are not getting in a car. And Gojek is by many considered the most innovative ride-hailing company in the world. Before anyone else did, they had integrated food delivery with their people moving, and they integrated package delivery. So you can think of this as Uber meets DoorDash meets FedEx Ground, all of it happening on two wheels. And it also is like PayPal because, and this is one of the other things that's starting to show up in the story, it's exciting. When this company launched, nobody had bank accounts or any other form of digital money. And so was paper money. And Gojek developed their own payments platform. And then it reached critical mass in terms of its user base and the driver base. And all of a sudden, that payments platform becomes used for other things beyond just the ride or the food. And these fintech businesses that were being created not as the core business are scaling to a point where they're going public as their own separate entities. And Gojek's got a fintech business. Now, Gojek is merging with Tokopedia, which is the Amazon.com of Indonesia. So now you've got Amazon with now, and Tokopedia also has a payments platform. So you've got the Amazon and PayPal, if you will, are merging with the Uber, DoorDash, FedEx Ground, Venmo of Indonesia. So Gojek, this company will come public, not clear where it will choose to list, but hopefully it'll get some good coverage. And finally, my second favorite South American company is Nubank. And this one will get coverage. It will trade on the New York Stock Exchange, probably before the end of the year. This is the largest online bank in the world and in Brazil, but operating all over the place. And it has half the number of accounts as Wells Fargo, but it's growing at 50%. So this one will get some good coverage. It will list, it's going to list, I think, both in Brazil and here. And they just raised what will probably be their last private fundraising, which was $500 million from my heroes in Omaha. So again, that's the third fintech company that EMQQ is involved with that Berkshire's now a shareholder of. So this is a big deal. And beyond just the fundamentals and the revenue growth, the stories and anecdotes about how this device is changing people's lives is really amazing. I mean, you've got hundreds of millions of people in India that are seeing a computer screen for the first time. And it is really an information and knowledge, and people that have never seen the Taj Mahal can get a video of a drone fly, you know, everything is now available for them, and it's really a big deal in many ways beyond just the revenue growth of the company. So now, in summary, this is a growth story, and I believe an unprecedented growth story. I think it's explained by these three mega trends happening at the same time. And again, as we've sort of gradually gone from computers to smartphones, and from dial-up modem access to cable to Wi-Fi, everyone's just skipping all that and they're leapfrogging it. And I think that helps explain the incredible growth rate. Important side benefits in a part of the world where corporate governance is your biggest problem. You actually have very good governance in these companies, which is why they choose to list on our exchanges. They're getting funded by Harvard and Stanford and Berkshire Hathaway and the like. And finally, you get a lot of exposure to frontier markets and private companies like Nubank and Gojek, because Alibaba and Tencent have already invested in them for you, if you will. So now let me just talk about China, and I'll make this quick and concise, but everybody, at least the last couple months, wants me to talk about this. So we had a crisis in China, and it's led to a pretty significant decline in the price of EMQQ. We're down about 40%, a little less than that from our February peak. And, you know, in China, the word for crisis is a combination of two words: danger and opportunity. And I think the danger's happened. And I think we've got pretty good opportunity right now. So July was a wipeout month for sentiment around China. It started with the DD IPO, which was sloppy and rattled people a little bit. And you know, they did the IPO. The next day, the cybersecurity agency announced an investigation. The people said, "Oh, you must have known you were going to be investigated," and the company had to issue a statement saying, "No, we did not know we were going to be investigated," and we got mixed signals as to whether or not the regulators were okay with us going public. And I think that was true. They got mixed signals because in the last year, there's been 4 different regulatory actions that have rattled investors from 4 different regulators. And China lacked a really clear, straightforward process by which these companies could make sure that they were good with all of the regulators and the regulations that they're in charge of. And the way I like to describe it, if you think about when you go to a country or come back from a country, there's a very clear process, and it ends when they stamp your passport and hand it back to you. Well, China didn't have a single sort of point of approval. So now they've sort of hastily put something in place and will tighten that up. But that left people kind of spooked, like what's going on? And the market was rattled. And then a couple of weeks later, this happened. And it was the Chinese government announced a pretty significant crackdown on the private education businesses, and that if these companies were teaching the core curriculum, the stuff the kids are supposed to learn in their government provided school, that they couldn't teach that for a profit. And that spooked investors. The one thing I lived with for 16 years is the most common thing that an investor comes to the table with when I talk to them is they've never been to China in 90% plus of the cases, and they're afraid of China. They think that somehow, some way, the Chinese government is going to steal their money. And that's been this general fear that I've seen from my first days as a China investor. And they never have a real good example of how it would happen or an example of it happening, but it's just this constant fear that the Chinese Communist Party is evil and they don't care about me and they're going to steal all my money, or they're going to make Alibaba's stock worthless, or they're going to take over Alibaba, or whatever it is. They're always worried. And in the action that they took on the schools, they didn't actually steal your money, but if you were an investor in the 3 publicly traded Chinese education companies, you did lose not all your money, but a lot, maybe 90%. And so it looked and felt like people's biggest fear, and the market went into free fall. The Chinese internet companies lost all support, and it was palpable, and I loved it. All of the things they say every time China gets involved, the Chinese government is here to steal your money now. We knew it was coming. And the 27th of July was an awesome day, and one I will never forget my entire life. It was the most fear I had ever seen in my corner of the stock market. Everybody was running around with their hair on fire. Kathy Wood was selling her stock, so you knew it was bad. And I was very thrilled by this because I wasn't worried about all these things, and I've devoted 16 years of my life to China, and I should have some kind of an edge, if you will, in some way. And I simply didn't see that the Chinese government was doing anything too different than our government and governments all over the world, which is dealing with the fact that these platform companies have become enormous and powerful and important. And no regulators have had any chance in keeping up with them. And it's not just China. And in great irony, while people are dumping their China internet companies because the Chinese government's putting in some regulations, the FANG stocks are making new highs, and the front page of the New York Times is telling you that our government is ready to attack. And so I thought it was awesome. So all of this stuff that's gone on, and I don't want to go deep into these, but none of these bother me. The first two things, the Ant Group, they had to stop that IPO because they had to change the banking, the rules that the lending part of Ant Group was operating under, and that was a good move and smart move by the regulators. The antitrust monopoly issues, that's noise. Those things were obvious and clear, and the fact that they cleaned up both of those things in April, to me, proved one of their advantages, which is, yes, they are different than us. They don't have lobbying and special interest groups and hearings and Facebook running ads telling you how they're not going to do something bad with your data or whatever. So it freaks out investors, but it's pretty efficient in my mind. And ultimately, the question here is, does China believe in capitalism or not? I think the answer is yes, they have to. It's worked there better than anywhere else for the last 30 years. So I think this is really more of an opportunity than anything else. And when I was young, they told me to buy fear. And there's no doubt that fear is here. I mean, we're up a little bit from that July 27th sell-off, and maybe we'll go back below it, but I'm not worried. So valuations are reasonable, which I'll review again in a second. So now we're still number one since inception by far out of all emerging market ETFs, even after a 40% decline. And even if we started that race from scratch today, I'm very confident we'll be number one again based on current valuations, but maybe we'll be number two because this other product we've launched, which is a subset of EMQQ, I think is pretty compelling. I'm just going to show you a couple of things to consider with FMQQ. So again, FMQQ is EMQQX China. And again, we're just pulling out. I mean, we're not literally taking out. These stocks still exist in EMQQ, but we've created a separate product to track the non-China part of the fund. And let me just point out three things. Again, this group is just now passing 100 billion in revenue, which is where the China internet companies were 6-7 years ago. There's 4 times as many people in the FMQQ countries as there is in China. So that purple is being generated by 4 times the number of people that are generating that gold revenue. And the e-commerce penetration in China, as you see on the left, is about 25%, going to 30 fast. Meanwhile, in FMQQ countries, it's 1/5 that. So 4 times the people, 1/5 the penetration. I don't know where this purple revenue is going. It's going to go to 500 billion at some point, and probably 1,000 billion and beyond. So I think this internet story in the developing world has a very, very big opportunity, and I think we are in very, very early inning, early in the first, I think. So, and valuations for this group are quite reasonable as well. You can see here the PEG ratio for both EMQQ and FMQQ is 0.75, which is pound the table valuations to me for long-term investors. So again, I don't know what is going to work the best over the next 5-10 years, but I think they're both going to work pretty well. So Michael, that is the conclusion of my talk, and I can do a minute or so of Q&A if you want, or we can just move on and let you continue.
We actually are out of time today, Kevin, but I will send you the questions that came through, and you can answer them directly. I apologize for that.
No, that's fine.
All right.
And anybody that wants can reach me at, or if you want to reach out to me or to my colleague, Kira Benson, in the lower right.
Kevin is a best of breed, as he went through in his presentation today. And for those of you that tuned in, you'll obviously agree with me. It's always great to have people like you on. This session was very educational today. Thank you very much, and we hope to have you back soon.
All right, Michael, thanks again for having me.
Thank you.